ARM jumped 11.3%. Lab scores at 75 out of 100. Strong buy. The rally rides on two hardware pillars that lock in future AI licensing revenue. Those pillars cover custom AI accelerators and next-gen server architectures, each targeting massive addressable markets. Stay tuned as the lab tears apart the design wins, margins, and roadmap that power this breakout. ARM's hardware licensing model is an absolute competitive fortress because it's ARM9, the latest generation of ARM's processor design rules that doubles the royalty rate of older architectures, is capturing double the royalty rate of previous designs on every single high-performance silicon die. While Wall Street obsesses over software margins, the physical reality is that hyperscalers cannot build modern custom accelerators without ARM's ISA. Instruction set architecture, the abstract model of a computer that defines how software controls the CPU. Consider NVIDIA's Grace Hopper superchip. It pairs a Hopper graphics processor with a 72-core ARM Neoverse V2 CPU, relying on SV, scalable vector extension, a specialized hardware instruction set that accelerates complex machine learning math directly on the CPU. This tight integration allows hardware designers to bypass the massive thermal and latency penalties of x86, the traditional Intel and AMD processor architecture that requires complex hardware decoding. By moving to custom silicon like Amazon's Graviton 4, hyperscalers reduce power consumption by up to 30%, directly solving the data center power wall. Today's 11.3% stock surge to $380.81 reflects this structural dominance, as billionaire capital rotates out of software and into ARM's bottleneck IP. With a beta of 3.79, the stock reacts violently to hardware wins, proving that the physical constraints of power and silicon efficiency are the ultimate arbiters of stock market value. Quarterly financials showing modest revenue momentum for ARM. By Q3 2026, a hawkish Fed pivot combined with global trade fragmentation will compress ARM's valuation multiple by 15% as rising capital costs squeeze hardware R&D. The macro environment is no longer a passive backdrop, it is a tightening vice. While the yield spread has normalized to plus 0.40%, Fed officials are openly threatening interest rate hikes to combat stubborn inflation. With the Fed rate sitting at 3.63% and unemployment at 4.3%, the cost of capital is rising precisely when semiconductor firms must fund next-generation designs. This monetary friction threatens to halt the multiple expansion, an increase in the price-to-earnings ratio investors are willing to pay for a stock that has propelled ARM's valuation, especially as prediction markets price recession risk at 7.2%. Simultaneously, a geopolitical storm is breaking over the semiconductor supply chain. Escalating trade wars and nationalistic resource protectionism threaten the global flow of silicon. Specifically, U.S. export controls on advanced GAA, gate-all-around, an advanced transistor design that wraps the control gate around all sides of the channel for maximum efficiency. Transistors prevent ARM from licensing its highest-performing Neoverse V2 cores to Chinese giants like Alibaba. Furthermore, ARM's primary licensees, including Apple and NVIDIA, rely entirely on TSMC in Taiwan for fabrication, exposing ARM to catastrophic regional conflict risks. While today's 11.3% surge shows immediate strength, these macro currents are shifting. ARM cannot outrun the physical reality of fractured supply chains and a hawkish Fed, which will ultimately dictate whether its 47.9% EPS growth can survive this global fragmentation. ARM reported earnings per share of $0.60, beating the Wall Street estimate of $0.59 by 2.1%, a solid beat that signals strong execution. ARM IP licensing is trending higher at $380.81. Segment 3, the PR Insider Filter, ARM management's headline this quarter. The value gained by accelerating time to market outweighs anything customers are considering. 3 words: value, accelerating, outweighs. Designed to make you feel ARM's pricing power is unshakable. What they don't want you to think about: that every smartphone OEM is staring at a minus 20% unit decline and a bill of materials crisis. The PR script is pure distraction. Focus on the value, not the volume. Now the decode. Insiders net sold 302,915 shares in 90 days. That's not a tax sale, that's a pattern. Historically, this precedes a royalty reset or a licensing slowdown. EPS beat by plus 2.1%? Fine, but the streak is masking the real story. R&D is now 56.4% of revenue, up 34% YOY. That's not efficiency, that's desperation. ARM is burning cash to outrun commoditization, and the silicon doesn't lie. V9 CSS adoption isn't accelerating because customers love it. It's accelerating because they can't afford to miss the cycle. The value pitch? A smokescreen for unit collapse. Last quarter, Rene Haas said, record demand. This quarter, he pivots to seasonality and unusual timing. That's not a clarification, that's a downgrade in disguise. The Q&A is where the truth slips. When asked about memory impact, Haas deflects to Jason. When pressed on V9 offsetting unit declines, he defaults to contractually agreed pricing. Translation, we're locked in, but the lock is about to expire. The momentum breakdown for ARM. RSI sits at 60, pointing to bullish momentum with buyers in control. MACD is currently bearish, with downward histogram pressure. The bull case rests on two hardware pillars. First, the massive industry pivot to custom hyperscaler silicon is accelerating adoption of the ARM9 architecture, which commands double the royalty rate of older designs. Second, the rapid rollout of Copilot Plus PCs powered by Qualcomm's Snapdragon X Elite processors will aggressively expand ARM's market share in Windows laptops. But here's what breaks the bull thesis. ARM is hitting immediate physical and legal walls. U.S. export controls restrict licensing its high-end Neoverse V2 cores to Chinese customers, while the high-stakes legal battle with Qualcomm threatens its core IP. Intellectual property, the legally protected chip designs that ARM licenses to other companies, royalty stream. The critical question Wall Street ignores is this. If Qualcomm successfully validates its custom Nuvia cores without paying ARM's new royalty rates, does ARM's licensing model collapse? The lab's answer is yes. If Qualcomm wins, every major licensee will demand renegotiation, vaporizing ARM's margins. With the RSI, Relative Strength Index, a momentum indicator that measures the speed and change of price movements on a scale from 0 to 100, at 60.9, the market is ignoring this existential structural threat. Our 75 out of 100 AI conviction score dictates our final call. If ARM settles the Qualcomm dispute favorably by Q4 2026, the stock breaks resistance at $411.83. If litigation drags on, expect a pullback to support at $209.16. We expect the legal overhang to persist, making the downside scenario highly probable. Tesla ticked up 1.8%, but our lab score is 50. Hold. Buyers are bidding up shares on optimism surrounding a $25,000 next-generation vehicle platform. However, scaling this new architecture requires massive near-term capital expenditures that will squeeze automotive margins. Our full teardown reveals whether Tesla's high-margin software can offset these heavy hardware manufacturing bottlenecks. Tesla's custom silicon strategy is a structural liability right now because its Dojo D1 chip, a 645 square millimeter custom processor fabricated on TSMC's older 7nm node, lacks the ultra-high interconnect bandwidth, the data transfer rate between different computing dies, to match modern hardware. While Wall Street treats Dojo as a software-like mode, the physical reality is that its 9 terabytes per second on-chip bandwidth is throttled by packaging limitations. When compared directly to NVIDIA's Blackwell B200, which utilizes advanced CoWES, chip-on-wafer-on-substrate packaging that stacks dies vertically to hit high throughput, Tesla's older multi-die architecture faces massive latency penalties during heavy deep learning workloads. This hardware bottleneck forces Tesla to rely on external merchant silicon, which directly eats into its margins. The hardware reality is that training full self-driving, Tesla's autonomous driving suite that processes video feeds using neural networks, requires massive clusters of NVIDIA chips rather than its own proprietary silicon. This dependence on third-party hardware exposes Tesla to severe capital expenditure pressure as NVIDIA commands pricing power. Today's 1.82% stock rise to $406.43 was driven by retail enthusiasm over SpaceX's market debut, but the underlying engineering reality shows a widening compute deficit. Until Tesla can transition its Dojo platform to a 3-nanometer node, its autonomous driving margins remain captive to NVIDIA's pricing. Quarterly financials showing modest revenue momentum for Tesla. By Q4 2026, the dominant macro force of protectionist trade policy will compress Tesla's automotive gross margin by at least 250 basis points. While ARM surged 11.3% today on custom silicon licensing momentum, capital is rotating away from capital-intensive automotive platforms. The Federal Reserve's 3.63% policy rate acts as a persistent friction, lifting borrowing costs for Tesla's factory expansions and raising auto loan rates for consumers. This monetary headwind arrives as prediction markets price a 7.2% recession risk, threatening Tesla's 15.8% revenue growth. Simultaneously, the imminent phase-out of the U.S. electric vehicle tax credit, a federal incentive program that reduces the purchase price of clean energy vehicles, forces Tesla to reprice its entire vehicle lineup, directly eating into unit economics. Beyond monetary friction, the geopolitical landscape is fracturing. Today's trade war escalation over Greenland-style resource protectionism, the aggressive hoarding of critical battery minerals like lithium and graphite by sovereign states, threatens Tesla's upstream supply chain. With new tariffs on Chinese auto parts, Tesla's reliance on imported components faces immediate cost escalation. This protectionist environment is a major headwind for Tesla's global manufacturing footprint, especially with 4.3% unemployment, signaling tightening consumer labor costs. While the retail crowd bid the stock up 1.82% to $406.43 following the SpaceX market debut, they are ignoring the structural trade barriers. Tesla must navigate a fragmented global supply chain where national security priorities override free market efficiencies, capping its near-term valuation multiple. Tesla is trading below its 20-day average, currently at 406 points. Management's headline this quarter: results of operations and financial condition. 3 words so bland, they practically scream nothing to see here. That's the PR playbook. Bury the lead in corporate boilerplate. Make investors dig through an 8K exhibit just to find the update, and hope no one notices the absence of a live call. What they want you to feel: stability. What they don't want you to ask: why the silence? Here's what the silence says. Insiders net sold 57,824 shares in 90 days. No named executives, just a steady drip of liquidity. That's not panic, it's portfolio rebalancing. But when the people who know the roadmap best are trimming while the stock sits 30% off highs, the message is clear: we're not buying the dip. And while SpaceX soars on its debut, Tesla's R&D efficiency, $6.4 billion, up 41% YOY, isn't a growth story. It's a tax. That's 6.8% of revenue poured into a pipeline that hasn't delivered a new vehicle platform in 24 months. The hardware reality? Tesla's in-house AI chip is still stuck at 7 nanometers. Blackwell is 3 nanometers, and even Intel's 18A is lapping them. What management is saying is business as usual. What the lab hears is we're burning cash to catch up. Last quarter, the update led with record deliveries. This quarter, it's financial condition. That's not a pivot, it's a retreat. No mention of the Cybertruck ramp, no FSD timeline, no energy storage growth, just a sterile recitation of numbers. The Q&A would have revealed the cracks, but there wasn't one. The momentum breakdown for Tesla: RSI sits at 43, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Tesla's bull case rests on its software monetization and the upcoming low-cost vehicle cycle. By treating its fleet as a hardware platform for over-the-air updates, wireless software deliveries that add vehicle features post-purchase, Tesla can generate high-margin, recurring revenue. Additionally, the $25,000 Model 2 Shanghai production could unlock massive volume. But here's what breaks the bull thesis. Competitors like BYD are deploying their own over-the-air update systems, eroding Tesla's edge. Furthermore, a regulatory crackdown on autopilot, Tesla's advanced driver assistance system that automates steering and braking, after recent crashes could force a software rollback and severely damage brand equity. The critical question is, can Tesla maintain its trailing price-to-earnings multiple of 376.3 times as its hardware commoditizes? The lab's answer is no. If hardware margins compress, software revenue must scale exponentially to justify the $1.5 trillion market cap. With the technical setup showing bearish MACD, moving average convergence divergence, a momentum indicator tracking trend strength, momentum, the market is realizing this transition is taking too long. Our June 8th hold call at $408.95 was correct, as the stock consolidated down 0.6% to $406.43. If Tesla starts Model 2 volume production by Q4 2026, expect a rally to resistance at $442.10. If regulatory crackdowns halt autopilot, the stock will drop to support at $381.59. The lab's call. Expect a breakdown to $381.59 as trade friction limits near-term upside, supporting our neutral AI score of 50 out of 100. ARM surges to strong by 75. Tesla steadies at hold 50. Divergence demands swift action. Not financial advice. Do your own research.